Turning back to the Fed, though, for more on this possible quantitative easing by the central bank, I want to bring in Tom Tucci. Tom is the U.S. government bond trading head at RBC Capital Markets. His firm is one of the primary dealers for the Fed, and as we had brought you that news, the Fed had been surveying primary dealers. And Tom, we know that you're in constant contact with the central bank, but specifically with this survey in relation to quantitative easing, what have you describe to us what happened here?
Well, I think the situation that you really want to report is the fact that the Fed is constantly in contact with the primary dealers, asking for feedback, what their customers are doing and how they're viewing policy and such. And this is just kind of a general procedure. So I don't think it's anything out of the ordinary. Obviously, QE is a very hot topic right now, and it will be a major factor for us. But it is part of the day-to-day ongoing operations that the Fed uses in its connection with the primary dealers.
Right. But was there anything different this time around when they were asking about asset purchases and trying to get, some information on that?
No, I think what it is, people are trying to gauge the range and the impact, right? I mean, you even see it within the Federal Reserve themselves. It seems that obviously there's a diverse opinion about how people feel either comfortable or how big the operation should be. We've known for over a month that they're going to put this process to work. The question is, what's the structure going to be? And you mentioned earlier how Bill Dudley had mentioned $500 billion is kind of a starting point, and he's actually backed off from that. It seems like it's going to be more of an open-ended policy. I'm not so sure you're actually going to get a finite number. I think they're just going to kind of keep it open-ended and go month to month as the process continues into next year.
Okay, so maybe they'll start off with something and then move on from there. But Tom, how did you respond directly to the Fed?
I'm sorry, say that again?
How did you respond directly to the Fed and their questions?
Our viewpoint here is that basically that we're expecting, with the current mortgage reinvestment that's going on, which we'll just call that on average is about $30 billion a month. On average, on a monthly basis, we feel that the need for this is about $100 billion a month as far as Fed policy is concerned. Our response from our customers is this is something that's been anticipated for quite some time. I think that in general, people are asking, and I heard you say this earlier in the interview, kind of how will this feed down to the consumer? I think the most important thing to read into this is, why is the Fed engaging in this policy? The Fed is engaging in this policy because the administration, through the lack of effort because of the election process, has been absolutely no help in here in providing any kind of stimulus to the economy. The Fed is carrying the ball by themselves. So the Fed is saying, we can take duration risk out of the market, reduce and keep rates low, which we think will prime the economy. This is not an overnight fix. This is something where they want to create an environment which is business friendly. They think that in the end that will create investment, and that will in turn create jobs. It's a way of keeping the markets and the economy in a very pro-growth environment. We're not responding to a financial crisis. We're responding to no growth or momentum in the economy.
Okay, and no jobs. And I think that's a great point, Tom, that you mentioned about how the Fed is really going at it alone right now. No help right now from the White House or Congress. Tom, we're going to have to leave it there, but I appreciate your time with us. Tom Tucci joining us this morning.